Equities, we look at equities, we look at the currencies as well. Apparently for currencies, we have a different strategies, if you will, right? And you look at the different measures. For example, you look at interest rate differentials. You apparently also look at the growth exposure. We also look at, for currencies, what's something we call the external vulnerability, in the sense that for a country's fiscal picture and current account picture, if they have a lot of deficit and they have a lot of short-term debt rollover and they don't have a lot of foreign reserve to serve as a cushion, that at some point can cause the investors to lose faith to that country's equity market and currencies as well. So we do look at emerging market currencies as a complex and compare relative value, and also equity markets, as we said earlier.
What's your outlook in terms of potential returns for emerging markets this year?
That's a good question. Right now, we're not looking at the emerging markets being really significantly outperforming the developed markets. For developed markets, it was more catching up. As you know very well, the S&P just surpassed the 2007 peak and en route to getting further gain. And globally, developed markets were just catching up, right? For emerging markets, there's this slowdown going on, right? Because if the developed markets would be having anemic growth, that would inevitably affect emerging markets growth, right? And if emerging markets such as China would experience some static growth or slowdown growth, that would affect commodity markets, right? And for commodity exporters, especially for certain emerging markets, that's not going to help with their economy, right? So overall, there's this cautious optimistic. Exactly. In our mind, saying for emerging markets, we are optimistic, but with a certain caution.